Hello, everyone, and welcome to this month's Lido Poolside community call. My name is Keen, and I'm Head of Institutional Relations at the Lido Ecosystem Foundation. Before we start and jump into our planned agenda, I want to highlight what was recently shared on Lido socials regarding the Kelp DAO incident. The curator of the Lido Earn ETH Vault is actively working to deleverage positions and reduce risk across all strategies. The outcome for the RSE position is dependent, among other things, mainly on decisions and actions taken by Kelp, Layer 0, and Aave. Lido contributors will post further updates as the situation develops, and today we also have members of the Lido Earn team on the call to field any immediate questions from the community after the main agenda. To be clear, stETH and wrapped stETH are not affected, and the Lido Core staking protocol is not involved in this incident and has remained unaffected. And now we can move on to the main agenda. Today we will cover a walkthrough of the stETH risk assessment rating from Credora. We also have a panel discussion with guest speakers from FalconX and Fireblocks on building the 24/7 institutional engine. And we will also close with a presentation of the recent Ethereum improvement proposal directly from the author and explore the proposed solution to enhance the safety of delegated staking deposits at the network level in more detail. Before I introduce our first speaker, let me start with some housekeeping. You can post your questions on whichever platform you're watching this on, Twitter, LinkedIn, or YouTube. We'll address them after each agenda section and try to cover all of them. So, without further ado, let's start with our first topic. Credora recently published an independent risk rating for Lido staked ETH, which received an A+ rating. This is the first asset level rating issued on a liquid staking token at this scale in DeFi. So we're really happy to welcome Bernardo, risk analyst at Credora, to our virtual stage to walk us through the methodology and results.
Thanks a lot, Keen, and thanks a lot for inviting me and for having Credora explain the A+ rating we've assigned to stETH. Among the many assets we've rated already, stETH had to be one, naturally. So we're excited to publicize here a little bit on the reasoning behind why the A+ and how does it translate to a 0.10% probability of default, among the lowest we've researched on all the assets we've done. So just a quick overview on the methodology. I have 10 minutes or so and maybe a couple more for questions, so try to be quick here. We rate quite a few categories. stETH naturally is a derivative. We jump to the anchor PD, where for stETH specifically, we accounted for smart contract risk and asset reserve quality, custody, and active trading strategy do not concern stETH in this case. Then a few modifiers, what I'll get into, and then we arrive at the final PD and final letter rating by computing the anchor PD and modifiers together. But PD means probability of default, and per Credora's definition, that probability means token holders being enabled to redeem their assets so the protocol mechanics around the redemption fail in some sense, or the reserve of the protocol becomes insolvent. So default means one or both of these cases happening. So that's the PD. To break down the anchor, which we start the analysis by, and that carries the most risk, so the most impact on the rating, we start with a smart contract risk, 15 basis points. The justification is below. So exceptional number of independent audits, by far the largest we've seen in this quantity-wise and number of security reviews. Formal verification has been processed and reviewed by Credora last year. We accounted for the issues being fixed before deployment that the audit firms detected. $2 million bounty active, and more than 5 years of operations since December 2020. 0.15%. Why? This is modeled so the range of the PD for smart contract risk goes from 0.15% to 1.20%. So obviously stETH scores on the lower bound, and this is modeled against smart contract exploits, historical smart contract exploits, and they vary by this metric. Naturally, reserve quality really strong. It's just ETH, and ETH being the native blockchain token, really unlikely to default. So it's just pretty much a symbolic PD here, and it's backed one-to-one, of course. Then we apply a few modifiers on top of the anchor PD. No recent incident in the last 6 months. Just a minor slashing event on March this year, although it was minor again, and resulted in zero user impact. So we didn't register that as an incident exactly. Obviously, reserves transparently can be checked on chain. Price stability quite strong, volatility quite low relatively. No deviation above 1% over the last year. There has been a deviation July 2025, but that was 0.3%. So it doesn't quite cut our deviation threshold above 1%. So we account for that as very safe in the last year. Obviously, pretty strong dominant market cap within the LST category. These numbers are as of the when we reported the letter rating and we launched the report, so sometime last month. Governance decentralized and strong as well. Really quite a high or quite a long time lock, which is good. Dual governance has been introduced for stETH holders to have the power to veto DAO decisions. There's a 72-hour voting period, and stETH has scored positively on all the 5 emergency response metrics, being that the playbook when an incident happens, whether there's any kind of insurance fund, which that mechanism exists, there's privilege scope and constraints, on and on. So we arrive at the viewer may be wondering, the ranges that I present here may be a little counterintuitive, but they sort of try to lay out the metrics that are most impactful toward the probability of default again. So those are, in this case, the recent incident, transparency of reserves, and the governance metrics. The other 2 are more market related and do not quite impact as much, don't have that much criticality compared to the others, and usually also happen so they are impacted as a second order effect from the epicenter of the risk itself. So we arrive at the final notch adjustments and the final modifier, which leads us to 0.10% or A+ rating per Credora definition. So it rates a little bit and underscores some minor considerations. So pretty strong security profile again, on-chain, reported on-chain, and verifiable. Market dominance really strong, and DAO also quite strong. If I had to poke holes a little bit, and with regards to some considerations, one could argue still a little low on-chain participation, although so there's this minimum of 5% quorum, which often clears with a narrow margin. Then there are these sort of two modes of validator sets. There's a permissioned, which holds quite a big chunk, 92% of stake ETH, and the permissionless, which is capped at 5. Although the permissioned itself is not that centralized, because I believe there are 30 plus operators within it, so that's a positive sign. Even though permissionless still at 5. Although I don't know the status right now of the proposal, but there was some plans to expand to a 10% cap, so that's a positive signal. So then legal and regulatory risk seems to be getting more important. This wasn't accounted for on the rating because a little hard to know how to translate this very qualitative metric into a quantitative one, and know how to assess, how to make that impact the final rating. So it's just so this SEC case referenced Lido as referenced the Lido token and alleged it to be sold as an unregistered security. But that was later dismissed because of, I believe, maybe lack of substance, or just lack of a regulatory framework and standing in that sense. So I hope I did well on time here, and essentially the final verdict by Credora was to rate stETH as an A+, and have a probability default around the 10% mark. So which kind of scores it among the highest rated. It's the highest rated derivative, I believe. So yes, thanks so much. Hope I have still a couple minutes for questions, if that's possible.
Super, Bernardo, thank you so much. That was a great talk and great presentation. It's really nice to see that stETH is Credora's first public asset level rating. Now what we can do is we actually move on to the Q&A session. So just a quick reminder to everyone, you can send in your questions on the platform where you're watching this. So again, Twitter, LinkedIn, or YouTube. Our first question I think I have is, how does stETH's A+ compare to other LSTs you've rated?
Yes, so as I said, the derivatives is the highest rated, and also the LSTs is the highest rated. Mostly because, so as you've seen in the presentation, the smart contract risk is one of the biggest drivers of the rating, and stETH is just really robust. So this the amount of audits, the formula verification being done, the longevity. So this scores, without naming others, this scores really on top of the herd here. Others are not as robust in the smart contract risk as stETH is. So that's the also governance really strong. But I'd say the smart contract risk.
Super, that's fantastic. And another question I have is, based on your analysis, do you believe stETH will be able to efficiently navigate the recent DeFi exploits we've been witnessing?
So, so try to. I'm going to try to be to provide you just an overview because this could take some time. But essentially, to talk about the latest 3 or so, I guess. So USR is essentially trying to not step over important details, but USR essentially was exploited due to an EOA with uncapped minting permissions. stETH is minted one-to-one algorithmically, so there's no uniparty minting manually in this case, or with the overwhelming powers. Then Drift has seen some. So they did have a multi-sig, but that was sort of socially engineered to just be one person, just hacking the protocol. And a major point of concern was no time lock. As I said, stETH has maybe the longest time lock I've seen, and that's just a minimum of 5 days, I think, with the opposition within the DAO that can extend to 45. So that's remarkable. Then the latest RSETH, as you talked about in the beginning, it was essentially just a bridge setup risk without trying to blame which one. That's an ongoing battle without trying to blame which one the fault will lay there. stETH is just native to Ethereum. So the bridged representation of stETH is the wrap stake ETH. So that would be the one that could be impacted by this sort of thing. But stETH is on the clear. So I think, summarizing, I think theoretically, as I see it, likely stETH would be clear of all these exploits. Although, they're getting creative, so it's a little hard to predict what's going to happen in terms of social engineering and these things that are hard to quantify on my side. But my job at Credora is to be as least wrong as I can and try to improve a little bit day by day. So I'll say that.
Super. And Bernardo, maybe before I let you go, what is the best way for people to get in touch with you?
So with me, you can at Ben VICC at Telegram, then at Credora Network on Twitter, and check we are launching some cool features soon. Not going to announce more. So yeah, and we'll keep we'll try to keep DeFi. Just try to surface risks is more important than ever, and we are the leading ratings provider. And hope you all follow us, make DeFi more risk aware. Know your risk.
Super, Bernardo. Thank you so much again.
Thank you.
Excellent. And now we can move on and introduce our panel discussion on building the 24/7 institutional engine. So I will be moderating this panel and will be joined on screen by Griffin Sears, Head of Derivatives at FalconX, where he leads the firm's global derivatives trading business, overseeing a broad range of derivatives products for institutional clients. Griffin brings extensive market expertise with a background in FX derivatives spanning sales and structuring. And then we also have the pleasure of Adam Levine joining us, Senior Vice President of Corporate Development and Partnerships at Fireblocks and CEO of the Fireblocks Trust Company, a limited purpose regulated trust providing qualified custody. Adam leads partnerships, corporate and business development, insurance, and license services. Gentlemen, thank you so much for joining us. It's really good to connect.
Thanks for having us, Keen.
Yeah, appreciate the opportunity.
Super. Adam, I might start with you if that's okay. So I think it was probably broad consensus that we used to say that you can have security or speed, but not both. So do you think that trade-off is officially dead in 2026, or is the argument still valid?
Yeah, at Fireblocks, we'd like to say that argument is dead for more than just in 26, right? Part of the core of Fireblocks and what we've been able to innovate is that instead of this tension between speed and safety, that when you're using a Fireblocks wallet, or even when using Fireblocks Trust, that you're not having to choose, right? And at Fireblocks, the goal is to have your cake and eat it too, right? Understanding the depths of security that not just the MPC infrastructure, but different transaction authorization policies and levels of security allow for our 2,400 plus clients globally to be able to move assets as quick as they need while not having to jeopardize for the security standards that institutions demand.
Interesting. And Griffin, from your side, what are you seeing?
Yeah, I think, really, I think the evolution, as Adam mentioned, of digital asset prime brokerage, like over the past few years, has really narrowed that gap between that trade-off. I think institutions now more than ever have the ability, to access a variety of different venues, deep liquidity in very much a secure and institutional fashion as well.
And Griffin, I think one of the things that always kind of comes up to me is this term of like institutional grade. Like, do you think the definition has changed since crypto ETFs got launched? Like, you have new crypto ETFs, you have new regulations. Like, what are you hearing from your clients on that front?
Yeah, I think it's really, it's really been a slow process, but it's one that continues to move forward. I think, since the launch of ETFs, only a couple of years now ago, I think, finding institutional grade access was difficult. I think for, a lot of participants who were, maybe tangential to the space, who wanted to invest in crypto had to spend a significant amount of time understanding settlement and custody nuances. I think ETFs have brought, not just Bitcoin, not just Ethereum, not just the majors. There's a very large variety of ETFs, representing different crypto underlyings. So I think it's it's brought quote unquote institutional grade product and exposure to crypto really at the forefront, to the forefront of access for a lot of different funds. I think, more to your question on, what is institutional grade and how has that changed? Um, it's custodying, it's trading, it's settling in a way that, to ensure you have proper guardrails around it, and that these larger firms, these larger institutions aren't, um, you know, risking their assets, their collateral, their funds on, more operational and settlement needs.
Interesting.
Yeah, Keen, I would argue that the launch of the ETFs has not changed the expectations or the standards of what institutional grade is, as much as provided a very clear public example that the industry is meeting institutional demand. Right? When we think about what the institutional grade is, it means that you're securing your assets, right? It means you're able to transact with them in a safe and secure manner, and that it's operating the same way that traditional finance does. What we've seen is we're supporting not just public companies, but heavily regulated institutions. It's the different types of certifications, and not just to check the box that you have a policy, but going through the different security standards and the regulatory colonoscopies in a variety of countries. That's not always public information. But when you see a variety of crypto ETFs that have been launched for a while, as Griffin mentioned, and they're operating as other ETFs do, right? There's not different standards because it's a crypto ETF. It's a very good public example that the institutional grade technology, infrastructure, trading, settlement has been built and will continue to innovate. Obviously, there's areas where the industry needs to continue to improve, but it is institutional grade at this point.
Yeah, and that's probably a good segue then, Adam. So I think a lot of people would think of Fireblocks MPC wallet offering a huge amount in the tech stack. Like we mentioned at the beginning, you launched the Fireblocks Trust Co. So maybe you could tell people a little bit more about the purpose of that kind of entity.
Yeah, I appreciate it. So for many years, we've had institutions come to us and say, look, we love your wallet. We want or need a custodian. It's possible because they want to separate between what they hold in self-custody and some they want in a regulated institution. There's also a variety of institutions that it really doesn't matter the asset type. They are not going to hold the asset themselves. In the US, you think about the registered investment advisors as a great example. Asset managers often don't want to hold the assets. They want to rely on a custodian. And so after a lot of thought, we launched Fireblocks Trust Company. So it is a qualified custodian. We were live since the end of 2024. And we're actively supporting institutions, both that only want to use a custodial solution and many existing Fireblocks clients that want to keep a portion of that in a qualified custody. So the exciting thing is that it's built on Fireblocks technology, so the ultimate of dogfooding, where we built a regulated institution that's using Fireblocks cold storage. And we're really indexing there towards the security and safekeeping, where those that want the speed and the institutional grade security continue to use our wallet infrastructure.
Okay. And these kind of QC clients, like from a DeFi perspective, like what type of requests are you seeing?
Yeah, it's the area that's heating up the most. And let's obviously the elephant in the room is what's been going on for the last few days, which is not good for the industry. But I would say almost a quarter of the conversations I've had just in the last 3 months has been focused on what do you offer in DeFi? Right? And DeFi can take a variety of meanings in a very vanilla way. They're saying, hey, what type of staking do you have? Do you have liquid staking? But where it's really heating up and where we think it's much more innovative is how can I leverage my assets in a qualified custodian and access areas like Morpho vaults, like Aave and others. And so we're in active conversations now with the regulator where I'm expecting to hear some news soon where while it will not be a in-custody offering, right? Fireblocks Trust will not be able to offer its own vault where it can promise that it's in custody. But actually what we're thinking about is really letting clients drive and helping them identify, well, they'll identify the types of assets and the curators that they trust. And as long as it meets our security and compliance standards, Fireblocks Trust expects to be able to facilitate DeFi. So hold the assets in custody, be able to deposit to the vault of choice that meets our standards, hold those receipt tokens in custody. That has come up often, and not just from DATs, but some traditional asset managers that want to get yield in a more risk-on way, but still leverage those custodians. I expect that trend to continue, starting with crypto, but RWA is the next sentence that comes up in almost every conversation.
And Griffin, I'm kind of curious to get your thoughts on like how are different institutions viewing staked assets like stETH? Like, what is their approach to, I suppose, collateral management? If we were to look at saying using Bitcoin as collateral, unstaked ETH, maybe USDC, like what strategies are you using there?
I think, yeah, I really think the advent of staked assets, liquid stake tokens, has been transformational for a lot of different market participants, particularly in the derivatives space. A lot of strategies involve leverage. So, whether you're trading on an exchange or you're trading with an OTC dealer like FalconX, there's collateral requirements, there's variable collateral requirements. There's sort of a hurdle rate if you are using a liquid token that has a native staking rate, such as Ethereum, Solana, others. For a lot of investors, they need to ensure their strategy is at least beating that sort of risk-free hurdle rate. And I'd say it's similar to almost in TradFi using treasuries instead of cash as collateral. You can run a number of different strategies and ensure, at the same time you're maintaining that staking income, on your underlying tokens, on your Ethereum or whichever token earning staking income is. And then on the other hand as well, from our perspective, as a derivatives dealer, we also want to ensure that if clients executing a leverage strategy, that they have the capital to support it, that we're not assuming any sort of undue counterparty risk. So it's really beneficial for both sides as well to have these liquid assets. I think on the investor side, they can ensure that there's not a drag, on their returns or on their balance sheet from having to post collateral to an exchange, or to a dealer. And then, on the flip side as well, the exchange of the dealers, are making sure they're maintaining, really limited, counterparty exposure from having custody of the assets, ensuring that there's enough assets to support, a derivative position.
And yeah, that probably leads me on to another kind of question I had. Like, we're definitely seeing like a huge surge in Bitcoin and ETH options. Like, do you think this is gambling, or is it finally at a point where we're at like real institutional hedging?
Yeah. I don't think it's gambling, and I think I think every year the options market in crypto resembles more and more what it looks like in traditional asset classes, whether it's equities, FX, commodities. A lot of we've seen this particularly this year, over the weekends around war headlines. Crypto is still one of the only sort of liquid markets, available 24/7, available during the weekends. So we've seen more and more funds, turn to crypto options, to express certain views, over the weekend in response to short-term moves. We've seen a lot of sort of larger global macro funds purchase puts as protection, broadly against their portfolio, ahead of certain events or sort of in response to certain events. And we've also seen an increase in sort of volatility-driven strategies, which again are quite popular in traditional asset classes. It's sort of an asset class of its own. I think there's more and more funds spending time looking at volatility surfaces, trying to identify opportunities within that. So very much so, these are sophisticated strategies. These are options used to broadly, hedge a portfolio, or perhaps, add a little bit of convexity in opportunistic times. But very much so, I'd say it's being used, in a responsible, And again, it looks very similar to the options market and other asset classes.
And Adam, maybe a question for you. Like, how is Fireblocks and FalconX working together today?
Yeah, so FalconX is a longtime client of Fireblocks, which we're really excited about. And while the Fireblocks Trust Company was looking to expand, one of the areas that became very obvious is many institutions are having conversations with Fireblocks Trust and saying, hey, we really need to not only use a custodian, but we're looking for an answer about how we're going to be able to transact, right? The trading. And there are a lot of custodians out there that are vertically integrated. What Fireblocks really believes in is being excellent in everything it does. And I'm sure no one's heard of the Fireblocks trading desk because it doesn't exist. And so what we've done is have conversations with who we thought was best in the market, and FalconX is that answer. Right? The depth of market, the liquidity, the capabilities that they have are far superior to many others in the market. And as a longtime client, we're excited to partner with them. And so what that means is institutions that are looking for both the trade execution, the capabilities of FalconX, but also need a custodian, they have that opportunity through that same UI, through the FalconX UI, to be able to transact as they need and instruct the Fireblocks Trust Company. Clients are still entering into one agreement with FalconX and a separate custodial agreement with Fireblocks Trust. It is not a tri-party, does not mean FalconX can reach in and take assets. You get the same standards, bankruptcy, remote, et cetera, but a really slick user interface, really strong client experience overall. And we're excited about it because it's not only working closer with the client, but we believe that when you look at alternative solutions in the market of those vertically integrated solutions, clients get a much better experience getting the best of FalconX and the best of Fireblocks Trust.
And that's kind of an interesting point. So you're seeing clients come forward with these interesting requests or demands. So like, how has like the average client changed over the past kind of 2 years, maybe for both of you? Like, are they significantly different, the type of client you're seeing?
Yeah, so I would say some of the clients or the types of clients that we started supporting early on with Fireblocks Trust are the same. It's just more of them, right? Some of the asset management community VCs that we're continuing to see, and actually many of them are very excited about our partnership with FalconX, so we're seeing that grow quite significantly. The things that are new, I would say, is in 3 areas. One is DATs, right? DATs didn't really exist 2 years ago. But the DATs and ETFs is different than I would say maybe 2 years ago. The other is more traditional asset managers. So those that have not been playing in the digital asset space that are starting to get into the space. And the third is Fireblocks Trust is not just a custodian, but we are a custodian for custodians. And so we're starting to see this sub-custodial play where institutions that want to get off the ground quickly with a broad digital asset story, not the buy, sell, hold of maybe 3 to 5 years ago, but a more comprehensive digital asset solution that can be crypto and RWA. And they're looking to completely outsource the support, the operations, all of that to Fireblocks Trust. And so that's something that's different than what we saw just 2 years ago.
Yeah, and I would add too. I think sort of the expansion of investable assets in crypto, and as Adam mentioned, that's DATs. There's also there's a much broader theme as well of a convergence of between traditional assets and crypto as well. RWAs, tokenized equities. There's even commodity perps on certain dexes as well. So, I think broadly what we're seeing is institutions are demanding, exposure to a variety of different asset classes, underlyings. And it's still a friction point as well to move that, it could be between exchanges, between venues. So likewise, echoing, Adam, we're very pleased to have, worked with Fireblocks to have this partnership. I think removing a friction point as simple as being able to trade, see your collateral, manage it, move it, see that in a single interface is really impactful, particularly for smaller funds who might not, have a large operations team. It really does make a difference and helps remove a common friction point.
And Griffin, I'd be curious to kind of get your thoughts on like, what is like the biggest challenge your clients are facing this year?
Yeah, I think it's I think it's that fragmentation. I think what we've seen is a lot of investors. Yeah, they've diversified the way in which they approach the market and invest the market. Even traditionally crypto native funds whose strategy were centered around different moments in crypto or picking certain tokens over another. I think a lot of those have expanded into equities via whether it's stats, whether it's more crypto linked equities, public companies that have a crypto business. And it's still very fragmented. So to invest in the equities, you might use an equity prime broker. They might not connect at all to crypto. So if you're a liquid book and you're sort of rotating positions around, it still requires quite a few hops to go from cash. Maybe you want to make an on-chain investment, you have to find another on-ramp, move those assets around to on-chain, move it to to a crypto custodian. So still that fragmentation exists. I think what's interesting is we're seeing some of the traditional venues begin to adopt some of the innovation from crypto. We've seen equities exchanges, we've seen the CME announce ambitions towards sort of 24/7 trading, continuous settlement. We've seen regulators as well begin to examine the use of stable coins for settlement. So all of those things, we hope in the future will become less fragmented, and sort of that line will be less of a friction point to jump. But currently, it is a friction point, and it's one that many different market participants are looking to solve.
And gentlemen, I have one final question for each of you. What are you most excited about in 2026? Adam, would you like to start?
Yeah, Griffin.
Yeah, I guess no, just continuing off my theme. I think I am very excited about this, convergence of sort of TradFi and crypto and DeFi. Yeah, I think longer term it's a trend that can't be stopped. And I think both asset classes are really learning from each other in terms of this. So yeah, I'm excited about the prospect of really all RWAs and sort of it might start with commodities or tokenized equities, but I think there's immense benefits to having 24/7 liquid access to these assets. And it really is true to some of the original ethos of crypto and building on chain. So I'm quite excited about that.
My answer is not going to be that creative. It's similar to Griffin. I think about the utility of the technology, and there's going to be more light bulbs, more people having that Buddha moment of enlightenment, that when you're able to leverage the technology, you can start to do traditional things better, right? Using perps as a hedge 24/7, as Griffin's talking about, seeing more and more leading indicators of real world assets moving on chain is going to give a lot more benefits. So for this year, I'm just excited that more people understand it or starting to leverage it in a really meaningful way. What we envision is things where leveraging DeFi and curators as part of your traditional investment advisory mantra is going to happen. Probably not in 26, but those sort of things are all about the utility of the technology. And you can replace Bitcoin staked ETH with RWA, with all sorts of other assets. Those are the things that get us really excited.
Well, guys, unfortunately, we're up on time, but thank you so much for your time. It was incredibly interesting, and thanks so much for joining. It's really appreciated.
Thank you very much.
Thanks, Keane.
Thank you. Excellent. And now I know many community staking module operators are tuning in today. So for the permissionless node operators who need points to apply as identified community stakers, and for those collecting Lido oats, we've got something for you. You should now see a QR code on screen. Scan it to visit the Galax page where you can claim your own on-chain achievement token for watching this call live. For identified community staker applicants, this oat will earn at least 1 point toward your proof of engagement score, and as usual, the minting is gasless. All right, so we can move on to the last section of our agenda. At the end of last month, Lido contributors published an Ethereum improvement proposal that aims to enhance the safety of delegated staking deposits at the network level and address a long-standing gap in Ethereum's deposit flow. So please welcome George, a chief protocol architect at Lido Labs, who will share the problem in detail, how the ecosystem deals with it now, and what the proposed solution is. George, the stage is yours.
Oh, sorry, I'm muted. Yeah, hi everyone, and thanks, Kim. I want to talk about an old issue in Ethereum deposit flow that affects every delegated staking protocol, and about an EAP that fixes this problem. And let's start from the basics. So first, solo staking. One person does both jobs. They provide ETH and they run the validators. So there is no conflict, one person, both roles. And delegated staking. The same two jobs, but split between two parties. The delegator provides ETH and the node operator runs the validators. And the delegator wants to stay in control of their stake, of course, right? And that controls depend on one thing, the validator's withdrawal credentials. This is the address that owns the stake and validator's rewards. So this address must belong to the delegator. But there is a problem here. And to see it, let's look at the Ethereum's deposit flow. Every deposit has a public key. The chain checks if a validator with this key already exists. If no, a new validator is created. And the withdrawal credential come from this deposit and they can be changed. If yes, it's just a top up to existing validator. And the withdrawal credentials are just ignored. So the first deposit sets the withdrawal credentials for the validator. And this is exactly what the attack exploits. The node operator generates the validator key. They sign deposit data with delegator's withdrawal address and send it to the delegator. Everything looks correct, but the operator still holds a private key. So they sign a second deposit, same public key, but with their own withdrawal address. And then the attacker just watches the mempool. And when the delegator's deposit appears, they front-run it, and their deposit lands first, creates the validator, and the withdrawal address is permanently set to theirs. So the delegator's deposit arrives next, but the validator already exists, so it's just a top-up. And the delegator's withdrawal credentials are just ignored. And this is how a malicious node operator can steal the delegator's funds. So how big is this problem? And at least 2/3 of all staked ETH is in delegated staking. In principle, all of it's exposed to this attack. Liquid staking and restaking protocols have built their own on-chain defenses. Exchanges and staking pools mostly rely on reputation and legal agreements. And a large share is unidentified, so we don't know if they affected or not, and do they have any defenses. So this is not a small problem. It affects most of the staked ETH. So why no exploits yet? And the reason is simple. Every staking protocol treats this as a critical and builds its own defense, like all of them. And let's take a look at these defenses, like how they work and what they cost. There are two main patterns: bonds in different forms and guardian committees. First, bonds. The operator deposits a small amount first, usually 1s, and then the validator goes through the entry queue and appear on the beacon chain. Only then the protocol can verify and change the withdrawal credential for this validator and deposit the rest. This works, but it's not perfect, right? This is the cost. First time, the entry queue is about 47 days right now, and the pre-deposit goes through it, and then the main deposit goes through it again. So activation takes twice as long. Second, idle capital. During this wait, the main staking sits idle from 31 to 2047s per validator, earning no yield. And third, the bond can get trapped. If the protocol decides not to fund the validator for any reason, the only way to recover pre-deposit is to deposit 31 Ether more, activate the validator, and exit. Without those 31 Ether, the pre-deposit is just lost. The second strategy, guardian committees. A group of trusted signers takes a snapshot of the deposit contract state. They check that no one else has deposited with the same public key, and if it's clean, they sign the snapshot. Once a quorum reached, the deposit goes through. But it's also not perfect. First, off-chain trust. Building off-chain defenses like this is always hard. You have to plan for compromised infrastructure and software, or signers colluding, and layer the defenses like rate limits, delays, and emergency pauses. Second, state coupling. Tying signature to a specific state isn't great. While you're doing the checks, getting a quorum together and sending the transaction, anyone can deposit and invalidate your work. So you have to sign quickly and deal with Griffin. Now let's zoom out. Every staking protocol solves this problem in their own code. Each one pays for development, audits, monitoring, and maintenance. And even after all of that, the solutions aren't perfect. On top of all that, new protocols start with zero protection. Before accepting deposits, they have to build the same defense others already have. So if you want to build a delegated, decentralized staking protocol, this is one of the first things you will have to solve. What if we fix this at the protocol level? The idea is pretty simple. First, the node operator signs a commitment to specific withdrawal credentials. Then the commitment can be published on chain. And finally, the delegator deposits safely with a Merkle proof of this commitment. And that's preregistration. And let's take a closer look. The first step, commitment. The operator signs a BLS commitment. It says this public key belongs to this withdrawal credentials. It's a new dedicated signature separate from the deposit data. The commitment is then submitted to a system contract. It's stored on the consensus layer and verifiable on chain. The second step, enforcement. The change is backward compatible and no breaking changes in the deposit flow, just a few extra checks. When a deposit arrives, the consensus layer first checks if the key pre-registered. If not, the deposit is processed exactly as today. If yes, it also checks that the withdrawal credential match the commitment. If they match, the deposits go through. If they don't, it's rejected. So for any protocol using pre-registration, the front-running attack is no longer possible. Pre-registration is fully opt-in. For stakers who control their own keys, nothing changes. They just don't have this problem at all. For bond-based protocols, the path is easy. They replace the pre-deposit with a pre-registration call. They get a stronger guarantee, no capital locked, and no double key. For Guardian-based protocols, the deposit flow needs updating. In exchange, they can retire the wall of chain infrastructure. And this is a pretty rare solution. Only 2 protocols use this approach today, Lido DSM and Tranches protocol. Yeah, and so what does this mean for Ethereum? A very old critical vulnerability finally gets fixed. Most staking on Ethereum is delegated, and a big part of delegated staking is run by decentralized protocols. And pre-registration makes all of it safe by default and lowers the barrier for new protocols. For existing protocols, first of all, they become simpler. The wall defense layer we saw earlier can be removed. Less code, lower audit costs, and smaller attack surface. They become safer. The guarantee comes from the chain itself, not from each protocol or an infrastructure. And more efficient. The double queue, the stack bond problem, all gone. And the next steps. We are proposing this EAP as a non-headliner for Higata. To get it included, we need signal from the community. And the main ask, scan the QR code and join the discussion on Ethereum magicians. Support, concerns, objections, all of it helps. The other links on this slide are for further reading, the EAP itself, the research forum post, and the full problem analysis. And that's it. Thank you for listening.
Super. George, thank you so much. That was fantastic.
Yeah, thank you.
In terms of kind of next steps, so Lido contributors would really welcome feedback on the proposal and the approach. So please share it on the Ethereum Magician forum to keep the discussion transparent and public. George, thank you so much again.
Thank you, Kim.
Move on to the final part we mentioned earlier on in the agenda in regards to Kelp. So now I would suggest that we can cover those questions. I'm going to be joined by my colleague Marin from the Lido Earn team to answer those questions.
Hey everyone, pleasure to be here and to provide more information. Just for the reference, I'm doing strategy and partnerships for Lido Earn. So I'm basically in these topics from day one and from the moment of the incident. So happy to cover as much ground as possible with as much information that we can publicly share.
Perfect. Marin, thank you so much for your time. So the first question we have is from a LinkedIn user. How big is the withdrawal queue currently?
Okay, so there are 2 types of withdrawal queues. People often confuse Lido withdrawal queue, which is of stETH, the liquid staking. It is pretty inflated, over 400k ETH at this point, but that's a consequence of market pressures and sales of stETH in the market. But unprecedented reactions and trust into the protocol where it was purchased instantly, so conversion ratio never deviated a lot to what we've seen historically over the years when there were big incidents. And then it just cycled out for instant gains of the users who are willing to take the time risk. But if we are referencing Lido Earn as a separate product and withdrawal queue,
of EarnETH. It's currently sitting around 55,000 units of EarnETH. And it is a big impact, but it's expected that everyone requested the withdrawal for this type of thing when there's an incident. Sadly, we can't currently service these. Curator has paused unwindings, but that's for a strategic reason. In case everybody would withdraw, at the same time, there is a delay, a buffer that puts users at more kind of a protected status. They don't hurt the principal, but it would still incur fast unwinding of big positions, which incur slippage or various fees. And then in theory, you start losing principal. So these are kind of complexities around these products where the size of the queue and speed of redemptions actually matter, and they are highly correlated. So in case there are huge withdrawals, time is slower. If withdrawals are smaller, they can be serviced sometimes even faster, at a faster rate.
And the second question we have is also from LinkedIn. So please provide more details of the deleveraging process. How much is now in liquid assets versus still tied up in a liquid Aave pools?
So this is actually a good question, and I love that we get LinkedIn questions. It feels very institutional, to be honest. Love it. So I think the biggest issue here is exposure to the Kelp position itself. So when you look at it strategically, there's 111K ETH depth position, but Curator needs to keep it in place because it's unclear, is it the best move to leave it or to unwind portion of it, because you can repay the debt part on Aave. Now, this is a strategic decision where Curator has to assess information that comes from the projects, how the haircut will be theoretically shared. Is it on L2s only? Is it across the whole user base of RSETH? So it's monitored constantly and is the biggest pain point in terms of ETH. For the side of that hurts these type of walls the most at this point of time, it's not actually ETH. It's Ethena position, where you essentially loop yielding stablecoin, and then it's on Plasma Syrup USDT position, which also has $100 million depth, and it's not as fast as to unwind compared to the ETH correlated positions. But I want to commend the Mellow crew on executing unwindings the fastest in the market for the ETH part of the depth. So what they've done, you could have repaid A tokens. Like A token is an Aave token. So when you deposit your wrapped ETH into Aave, you essentially wrap it into a net new token, which is Aave wrapped ETH. With that asset, even during the freeze of the markets on Aave, you were able to repay the debt. So Mellow team essentially posted limit orders through CoSwap to service them RepStat, which is liquid. It can be either Aave RepStat or it can be vanilla RepStat, both fully liquid at that point of time. And in theory, what they've done is a magical trade where we got illiquid asset, repay the debt. In other hand, users got a way to post different collateral on Aave or to even go out from the position. But this drives us back more towards how the Lido specific withdrawal queue got so big. It was just unprecedented event in the market, so everyone was looking for safety.
Interesting. And 343, another LinkedIn user. I would highly encourage you to distribute what you can rather than waiting for full resolution, as it seems like it is more likely to be weeks or months, not days. In the meantime, my EarnETH, sorry, there's a second part.
There's more.
In the meantime, my EarnETH is stuck in the withdrawal queue, which is highly concerning.
Yeah, I understand the concern, but I wish to reinstate confidence to users in general. We are holistically doing the best we can to minimize the impact. There's also Lido first loss protection, that's a viable option to cover portion of potential losses. Like at this point of time, we actually don't know if there are going to be losses. So these things change. From our perspective, yes, it's been 6 days, and for us, it feels like moments. For users, it feels like years. We are putting all efforts to closing this gap as much as possible, working with all the parties on the market, and transparently, I can't share a lot, which would theoretically put any potential resolution at danger. But I can share that if we allow users to leave now, it would be at the absolute worst theoretical haircut. Meanwhile, there are very good signs that impact would be minimized and very beneficial for users to stay inside the vault. So it's very hard to balance between desires of users to act quickly and getting the best out of it for them. So worst case already happened, and it can't be worse than what they already requested. So the best thing is to really be patient, wait it out a bit, and hopefully we are into this for a much shorter time than this user thinks it will be.
Super. Marin, thank you so much. Oh, it looks like we have one more question. Would Lido earn deposit any ETH into restaking protocols after this incident?
So it's a good question. In one sense, we did inherit a lot of security assumptions from the underlying protocols, but I don't see this as a direct fault of the restaking protocol itself. The exploit happened on the Web2 infrastructure. The whole thing happened in a very unfortunate way, without, again, uncovering too much during theoretical legal processes in the background that are happening. But end of the day, it is DeFi, and if we have a good risk-adjusted returns, and probably with much stricter security, the answer would be yes. Would it be instant? Probably not.
And Marin, maybe one important point we didn't really touch on in detail is the protected element for earn ETH and earn USD. So maybe you could quickly talk about that.
Yes. So one important thing that I probably should have started with, earn ETH is the vault that has been affected. But on the earn USD side, there were no implications whatsoever. Vault is operating as intended, and we even didn't see withdrawal requests initially for that specific vault. We have some now, but it's being serviced within timeframes disclosed, and it all works as intended.
Super. Marin, again, thank you so much for answering all those questions and being so transparent. I think it was really valuable. So thank you so much again.
Appreciate the opportunity to share with the audience.
Perfect. And guys, I think the final thing for me to do is just thank everyone. So thank you for joining and being here for the past hour. This recording will be available and we will share the recap on our socials, so stay tuned there. The final point for me to mention is really just a call to action around consolidations. So for any operators or institutions looking to access stETH liquidity and DeFi integrations, moving into SD vaults, we're here to make it as easy as possible. So definitely get in touch with us. You can see the 3 different links available. So please reach out there if you want to connect. And again, thank you so much for joining the call. The next Lido community call will be a dedicated token holder update, which will be held on Thursday, May 21st at our usual time of 2 p.m. UTC. Thank you so much again for attending the call.